Hello, everyone. It's PJ Patterson here for a market update. Today is Monday, the 30th of August. I hope you all had a good weekend. Getting into the top three things today, I'm going to talk a little bit about deflation and an interesting setup that is going to be towards the end of this year with the U.S. Fed and the composition of the Board of Governors there. Secondly, talk about the quads. Just going to run you through a couple of key setups in the U.S., Europe, and Australia around the quad map and sort of the asymmetry of the way markets work. And then finally, just refresh the growth inflation policy model. And those are probably the three of the key factors in global macro that you have to get right. The direction of those three things: growth, inflation, and policy, or really policy is interest rates. So just jumping into the first item, which is the deflation of it all. So does this chart that is on your screen right now, the commodities index, look like deflation? Well, if it did look like deflation, you would flip that thing upside down and there'd be a big red arrow going from the left corner to the right corner, and that chart would be going that way. And that's what we had sort of early 2020 happening. But certainly since November of 2020, we have been in an absolute rip-roaring inflationary environment. And that's no more evidenced by the fact that this chart has just continued to push higher and higher. That's actually from the 25th. I think I've got one from the 20. No, do I not have it? No, I don't. Maybe this one. Let's see. Yep, there we go. That's the 26th. Anyway, next day. So we had a bit of a quad 4 scare week. That's the way I talked about it in the update that I left that week. And I think the narrative that drove that was around the COVID Delta variant, and that clearly there were people out there who were pushing a market correction narrative, a deflation narrative, a slowing global growth narrative. That's why you saw commodities come off, oil come off, stock markets correct a little bit. But the data didn't support that. And this is something that I talked about at the time. We continued to see things like the ISM surveys rising, durable good purchases rising, inventory buildups accelerating. All of this stuff that was positive economic data was going on under the surface of the water. And so the argument that we were going to enter a deflationary period really couldn't be supported. And of course, if we were to see deflation really come in full force, then you're going to see stuff like oil basically shoot to the downside very rapidly and stay there, by the way, and stay there. You're going to see commodities do the same thing, natural gas, all this sort of stuff do that. It isn't doing that. So we're not in a deflationary environment. And if I could just quickly show you the CFTC chart, a table rather, that I often show, that's how the market was positioned. We saw that the market was positioned, they're long treasuries, long the dollar, short a lot of other currencies, and short crude, short copper, short silver, pretty much set up for that environment that I just described, which is deflation. And we don't have that. So interestingly, what this could be a precursor of is the fact that we will see a continued rebound in commodities and oil and natural gas, and we'll see the U.S. dollar continue to fall. It's still in a bear market, and it hit some sort of key resistance levels, but didn't break. It bent, but it didn't break. So my anticipation, anyway, would be that we will not see any of this deflationary nonsense, at least until probably the first or second quarter of next year, depending upon data, of course. And we'll just continue to see the inflationary environment persist. Now, one of the interesting things that I was going to mention about the Federal Reserve Board of Governors in the U.S. is there's going to be a rotation of Fed governors. I'm not going to go into the inner workings, the mechanisms of the U.S. Fed, but suffice to say that I think there's 6 or 7, maybe it's 8 board members that set interest rate policy, and they rotate around in terms of the voting members of the Fed. And the current voting members are fairly dovish. So in other words, they're fairly supportive of interest rate policy being low, so keeping interest rates low, supportive of trying to get the economies fired back up again, et cetera, et cetera. Versus when this rotation occurs, we're going to have a predominantly hawkish Fed. Now, this is going to be real interesting because this hawkish Fed, first of all, they're not going to do anything uh, at the moment around interest rates because we have midterm elections in the U.S., which will be occurring, I believe, in November. And the Fed tries to be apolitical. They do not want to be seen to be supporting one party or the other with policy moves. So what that pretty much means is that they don't do anything around election time because they don't want politicians to, blame them, I suppose, for the outcome of an election. And they don't want to be seen to be influencing it either. I suppose that's fair. Um, anyway, it just means that they're probably not going to do anything until early next year. Now, interestingly, what they will probably do early next year is they'll begin to tighten interest rates. And they'll do this by removing the support that they've had in place for, forever, pretty much, at least the last couple of years, where they're buying. So what happens is the Federal Reserve monetizes debt by buying treasuries off the U.S. Treasury Department that they issue. And this is one of the ways that they keep interest rates low or suppressed, or at least they influence the interest rate market. And so when you're in a dovish environment, they're buying a lot. So if you've ever heard of this, they're buying 90, 100 billion dollars per month of U.S. Treasuries. This is the U.S. Fed buying these. And what they're basically saying is we're going to stop doing that, or we're going to begin to taper that off. We're going to start slowly dropping that down because then the market has got to absorb the free market, as it were, needs to absorb the difference. And so to do that, what you'll probably then see is the automatic reaction will be, in order to get people to buy these things, interest rates will effectively have to rise. So that's kind of just a basic primer on how that sort of stuff works. It's obviously much more complicated than that, but it's certainly, look, that's pretty easy to understand. But the Fed's going to potentially be more hawkish next year. Now, they're going to be doing this about the time that we're going to start entering a quad 4 environment in the US. So I just want to talk about the quads for a second. I do talk about these a lot. For those of you that are new to the firm, new clients, we have a 4-quadrant model. The quads are driven by 3 things: growth, inflation, and policy or interest rates. And if you get the direction of those 3 things right, what it tells you is pretty much the quad that you're going to be in. I'm not going to go into real detail on this, except to say that right now we're pretty firmly in quad 3. And this is a spreadsheet that I show from time to time. Pardon me. It is it's a quad map, and it shows us, and I'm going to flip over to a couple of other countries here in a moment and areas. But anyway, it shows us that in the U.S., pretty much 60% chance that right now we're in quad 3. That's pretty good odds. And certainly the data is supportive of that. And one of the things about this model is it's a forecasting model. And just out of interest, if any of you are interested in numbers and forecasting and that sort of thing, I just about to finish this book called Super Forecasting. It's the Art and Science of Prediction. Fascinating book about how to forecast. And one of the key things about forecasting is that when you make a forecast, you don't just stick to it. You don't just say that's going to happen because I think that's what's going to happen. Is the really good forecasters will change their forecast, and it usually revolves around probability. So it's not a binary outcome, yes or no. It is, what's the percent chance of that thing happening? So what's the percent chance of us being in quad 3 in the 3rd quarter of this year? Well, right now it's 60% because of what the data is saying. And that's going to change as data points continue to flow in and data is reported. This is in the US, by the way. That probability will probably go up. And then eventually, of course, once we get into the 4th quarter, we'll know exactly what happened in the 3rd quarter. We'll be able to say, yeah, we were in quad 3. So right now we're at a 60% conditional probability. Sure, quad 4 is still sort of, it's hovering out there. There's a 40% chance that we could be in a quad 4 environment. But again, and I won't show the chart again, but if we were truly going to be in that environment, we would see commodities, oil, natural gas, lumber, cocoa, coffee, all these things would start to come down in price, but they're just not doing that. Gaze your eyes to the 4th quarter and 1st quarter of next year. Now, what's interesting here is in the 4th quarter of 21, sorry, not next year, 4th quarter of 21, we actually have a pretty high probability, again, that we will not be in quad 4. And in fact, we could very well be in either quad 1 or 2, or even quad 3 again. And so what this does is it allows me to gaze into the future and to consider the type of portfolio or investments that we should have on, because certain asset classes and certain styles, they call them factor styles, do better in quad 1 and 2 than in quad 3 or 4. And so this is kind of the nuts and bolts of how I evaluate every single day, every single week, every single month, how to position a portfolio and how to take advantage of some of the sell-offs and the things that happen due to the volatility of the market, which I won't really talk about today. I will hit volatility briefly in a moment. But anyway, I thought I would just run through that because this is very powerful information. And one of the interesting things I'll just quickly share with you in this book, because I think it's very relevant to other things going on in the world right now. But one of the things that happens when people make forecasts or they make a decision about something and they think something's going to happen. So let's say you form a view on something and you say, well, this is going to happen. I feel that this is going to happen for whatever reason. And it's a psychological term that's used, which is belief perseverance. And it's basically that um, people are very unwilling to change their mind or change their forecast. And just a quote from the book, people can be astonishingly intransigent and capable of rationalizing like crazy to avoid acknowledging new information that upsets their settled beliefs. So, in other words, what I'm saying and what this book is saying about forecasting is, or probably anything really for that matter, is that once you have a belief, you tend to try to find confirming evidence of that belief. And you tend to only look for the confirming evidence and you discount other things that come along and to maybe uh, suggest that there's a different thing going on or that you need to adjust your belief. And I bring this up because if I did that in markets, there's a good chance that I would not be a successful investor over the short, medium, or long term, because you cannot wed yourself to a position. I've got a quote that I wrote down. It's not a quote really, it's just a little note that I wrote down. I was watching something, and I really do believe this in markets, is that you should never get married when it comes to a position. You're just constantly dating in the markets. So what I'm saying is, for those of you who are new, for those of you who are just trying to get your head around how all of this works, the quad map is a great roadmap to tell us how we should be positioning and investing. Because if we're in a quad 4 environment and you've got a quad 1 portfolio on, you're going to get your face ripped off. And I don't want that, because my job is to preserve and to grow your capital over time. And this is just one of the tools that is being used within my um, forecasting and other stuff that I do to achieve that goal. And you know what? All it boils down to is getting some of these probabilities stacked in our favor, investing that way, and then as new information comes to light, making adjustments. And you see me doing that all the time. If you're getting those reports, from the interactive brokers and so forth, you know that I might be in there taking some profit or buying some new positions if we're getting a sell-off, these sorts of things. Now, just quickly, because I'm probably getting a little bit on in time here. Anyway, I hope that's useful, because I think it's really valuable. What am I looking for? I think it's really valuable to have that perspective and understand. So I wanted to show you the Eurozone. Let's see if I can find it real quick here. The Eurozone. So this is the US. Come on, where's the Eurozone? There we go, Eurozone. Europe's a little bit different story. Europe is going to be smashing it in, first of all, as you can see here, there's a 95% chance that they're currently in quad 3. So that's really good. But then the probabilities tip massively to quad 2 and quad 1 in quarter 4 and quarter 1 of 22. So one of the reasons why I've pushed back into Europe in terms of owning some positions, and I'm looking to actually take advantage of any little sell-offs that we get in European equities, because this, ladies and gentlemen, is what we've just come through in the U.S. quad 1 and 2 environments, and it's just one of the best setups that Europe has had in forever, and there's reasons for that, which I won't go into. Let's hit Australia real quick. Now, Australia. not so good. So I'm talking now about the asymmetry of markets here, and basically asymmetry means that nothing is correlated, and that whatever happens over there doesn't necessarily mean the same thing's going to happen over here. Now, there's that old adage that the Australian markets tend to follow the U.S. markets. Now, I think we're going to potentially see a divergence in that, um, probably in the fourth quarter of this year, and I have a feeling. Well, first of all, let's just look at the probabilities. Right now, there's a 76% chance of being in quad 4 and a 21% chance of being in quad 3. So our two choices really at this point of the highest probability is quad 3 or quad 4 in Australia. Now, I have a feeling that conditional probabilities are going to get tipped a little bit more towards the quad 4 probability because of the fact that our governments, our state governments, and by default the federal government have been so stupid to keep these economies locked down. I just can't even, I'm not going to get on a rant here, but I cannot even believe that people are putting up with this. There are so many small businesses right now that would be getting absolutely crushed, that will probably never come back. And I don't know if the government's trying to get everybody hooked on welfare and government dependence so that we're all in a state of bondage at some point in the future, but it's just ridiculous. People need to exercise economic freedom. It's that simple. If we take that away, the ability for people to do that away from them, then we are in a world of shit. And I just can't, again, I can't believe that we are where we are. Good on the truckies for putting up a blockade. And, don't cancel, don't send me hate mail. But these are the kinds of extreme things that happen at particular moments in time in history that actually make a difference. So I'd be paying attention to what this actually, if it develops into anything. I certainly hope it does. Anyway, rant over for the moment. But anyway, Australia for the next couple of quarters is going to be in a bit of trouble. We're going to really be in a bit of trouble. And I think we could fix it immediately by getting the economies opened up again and just dealing with whatever comes along in terms of COVID. So that's all I'm going to say about that. Otherwise, I'll be here for another 2 hours talking about that stuff. Okay, so that's Australia, Europe, and the U.S. all looking really good. I'm not going to go into Asia and some of the Asian economies that are also looking pretty bad at the moment. Probably a little bit of that is influencing Australia as well. So we're staying out of Asia. I'm being cautious about how I invest in Australia. What you'll notice is with the positions that I'm holding, Australian domiciled positions, a lot of them are Europe, U.S., NASDAQ, and gold and a few other things related. So even a lot of the Aussie dollar positions being held are actually in favor of the international shares, as it were. Finally, let's just talk about growth, inflation, and policy real quick. So I've already touched on really, actually, you know what? I've already touched on everything I need to touch on there. Growth, inflation, policy. And I'm almost on 20 minutes, so great spot to probably almost wrap up. Now, did I show? I think I showed you the CFTC. Is there anything else here I wanted to just touch on? Quickly, volatility. So let me just hit a couple of key things because I often do talk about them, and I want to just quickly hit them so that you can have that reference point. So volatility. I talk a lot about volatility, and let's have a look at what volatility did. I already got the VIX set up over the last week and a bit. Look at that spike. Whammo. This is happening almost with regularity every month around options expiry. Again, it doesn't always affect the same market, but it certainly, we get these vol spikes. There's one, there's one, there's one. They're everywhere. There's one, two. And right now, the way that I play this is I take advantage of it. I use this opportunity, if there's cash available, whatever, to buy stuff that is on sale. Because again, for the moment, the trend that we're following could be a quad 3, could be a quad 2, whatever that quad is, and whatever jurisdiction is affected by this volatility spike, invariably I'll be looking to buy that. If anything, I won't do anything. I won't panic, right? This is what happens. Volatility spikes. People are levered up to the gills. This is why hedge funds blow up all the time in the US, because they're levered 20, 30 to 1, trying to be smartest guys in the room, making these big bets on, 3 or 4 or 5 stocks. Big volatility spike, something else happens, and basically they get their head handed to them. And they have to close up shop, or they take 30 or 40, 50% losses. This happened in 2 hedge funds recently. Anyway, not going to go into that. Let's talk about oil volatility real quick. Again, oil vol, sort of spiked a little bit in the last couple of weeks and stayed elevated, but then has come off nicely. So hopefully we'll just continue to see oil fall. And don't know what the hurricane in the U.S. that's just hit Louisiana is going to do to oil prices. Might send them a little bit higher because I think they shuttered something like 74% of the oil platforms in the Gulf of Mexico, which is a massive oil producing and natural gas producing area for the U.S. So anyway, we'll see what that does to the price of oil. What else can I tell you? I think that's about it, really. So at this stage, business as usual. Quad 3 in the U.S. That's how we're invested. Looking for opportunities at the moment to potentially pivot harder into a Quad 1, Quad 2 scenario. Looking to play Australia fairly cautiously around how we're investing. I think that's about it for now. Hope you have a great week. And any questions, please pop them in the chat or the messaging underneath this message. Happy to answer those. If you have any other questions that you specifically want to ask me or conversations that you want to have directly with me, you know where to find me. Calendly, book yourself into the calendar and or call me or text me. Have a great week. Talk to you soon.